I want you to picture a scenario. And I guarantee almost every single person listening to this has faced this exact situation.
Oh, I'm sure.
You're standing in a store, or maybe you're sitting in a car dealership, or just scrolling through Zillow, looking at houses,
Mhm.
and you see it. You see the one.
Ah, the shiny object.
Shiny object, exactly. It's perfect. You can see yourself using it. You're already visualizing how much better your life is going to be.
You're emotionally committed at that point.
Completely. You've mentally moved into the house, or you're driving that car down the coast. But then you look at the price tag.
Yep, there it is.
And not just the sticker price, right? The monthly payments, the insurance, the maintenance.
The reality check.
Right, and your stomach just drops. Because your rational brain, that really boring buzzkill part of your brain, kicks in and says, you know, if you buy this, you are going to be eating instant noodles for the next 5 years.
Yeah. So you put it back.
You put it back. You walk out of the dealership. You close the browser tab.
And in the moment, I mean, it feels terrible. It feels like a massive loss.
It feels like a failure. But today on the Deep Dive, we are going to argue that walking away that moment of putting it back on the shelf might actually be the ultimate power move.
It really might be.
Because this week we saw an $80 billion version of that exact scenario play out on the global stage.
We certainly did. We are recording this on February 28th, 2026. And I mean, the business world is just absolutely reeling from the news that Netflix has officially walked away from acquiring Warner Bros. Discovery.
This was supposed to be the deal of the decade.
Right.
The streaming giant eating the legacy giant, and then just poof, gone.
And while all the headlines out there are screaming about failed talks and bidding wars, our mission today is to look at this through a totally different lens. We want to treat this deep dive as a masterclass in capital allocation.
Capital allocation, which, let's be real, is a phrase that gets thrown around a lot in finance, but it sounds incredibly dry.
It sounds super dry, but it is actually the most exciting part of business.
Okay, sell me on that.
Well, it's the art of deciding where to put your money so it grows the fastest. And the mystery we are going to solve today is this. Usually, when a company loses a massive deal, their stock tanks because investors think they failed to grow.
Right.
But when Netflix lost this deal, their stock went through the roof.
Yeah, the market reaction was wild. So let's unpack this. We need to set the scene for this battle first. It was basically a heavyweight fight for the soul of Hollywood. In the blue corner, you have Netflix. In the red corner, you had Paramount Skydance. And the prize they were fighting over was Warner Bros. Discovery.
And just to be clear for everyone, when we say Warner Bros. Discovery, we aren't just talking about Bugs Bunny here.
No.
We are talking about a massive, sprawling empire.
Right. So break down that inventory for us. What were they actually fighting over?
It's a vault of assets. You have the Warner Bros. Movie and TV studios, so that's Harry Potter, DC Comics, House of the Dragon.
It's huge IPs.
It's massive. But you also have the cable networks. CNN, TNT, TBS, the Discovery Channel, plus the streaming services like Max. It is essentially a century of media history wrapped up in one single company.
So Netflix looks at this vault and says, I want that. And they put a really serious offer on the table.
They did. Netflix put forward a proposal valued at roughly $82.7 billion.
Wow. Specifically,
they offered $27.75 per share.
Okay, let's stop there for a second. $82.7 billion. That is an incomprehensible amount of money. Why did Netflix think it was worth that? Because I thought Netflix was all about building their own stuff.
Well, think about the synergy there. Netflix has the best distribution system on the planet right now.
Over 270 million subscribers.
Exactly. And Warner Bros. Has the best intellectual property library.
So the logic is you take the Harry Potter library.
Right, you plug it right into the Netflix machine.
And watch the money printer go brr.
Exactly. Plus, they probably thought it was a pretty clean deal from a regulatory standpoint.
Oh, because they don't own those legacy assets.
Right. Netflix doesn't own a news network like CNN. They don't own a traditional broadcaster like CBS. So they figured, hey, the regulators won't mind this. It's vertical integration, not a monopoly.
So Netflix is sitting there with $82 billion on the table. They are ready to sign. And then Paramount Skydance comes flying in from the top rope.
Enter the disruptor. Paramount Skydance, or PSKY, on the ticker, they decided they weren't going to be ignored. They came in with an absolute knockout punch of an offer.
What did that look like?
They offered $31 per share.
Okay.
But the price wasn't even the only weapon they used. It was the structure of the deal. It was an all-cash offer.
Cash is king.
In mergers and acquisitions, absolutely. I mean, if Netflix offers you stock and Netflix stock drops tomorrow, your deal is suddenly worth less.
Right, you take on the risk.
Exactly. If Skydance offers you cash, well, $31 is $31. It removes the risk for the seller completely.
So we have a gap here. Netflix is at 27.75, Skydance is at 31 even. That is roughly an 11% difference. Now, Netflix is a $400 billion company. They're rich. They could have reached into the couch cushions and found the extra money to match that bid, couldn't they?
Oh, they absolutely could have. They have
Yeah.
the balance sheet to borrow the money, or they could just issue more stock. The capacity was absolutely there.
So why didn't they? If I'm the CEO, Ted Sarandos, and I really want to win, why do I let Skydance beat me over a few dollars a share?
Yeah, this is where we get into the discipline of the deal.
Yeah.
It's all about the return on invested capital, ROIC. The Netflix co-CEOs, Sarandos and Greg Peters, they had to sit down and do the math.
Right.
They had to ask themselves, if we pay $31 or $32 a share, can we ever actually make a profit on this investment?
You mean at a certain price, the shiny object just becomes a burden?
Exactly. It's like buying a rental property. At $500,000, maybe it makes you money every month. At $1 million, the mortgage is so high that you lose money every month, no matter how nice the house is. Netflix realized that at $31 a share, the math just stopped working.
So they issued this statement, and honestly, it was kind of a flex.
It was very blunt. They said, quote, "The transaction we negotiated would have created shareholder value. However, we've always been disciplined. And at the price required to match Paramount Skydance's latest offer, the deal is no longer financially attractive."
No longer financially attractive, which is basically CEO speak for we are not getting into a bidding war just to satisfy our ego.
Precisely. They refused to let the emotion of the auction drive the price up.
Now let's talk about the market reaction, because this is where the story gets really counterintuitive. Netflix says, we surrender, we lost. Friday morning, the market's open. What happens?
The stock went parabolic.
I'm looking at the chart in our source notes right now. It says the daily change was plus 14.03%.
14% in one single day. For a company the size of Netflix, that is a massive move.
Yeah, that pushed the price to 96.45.
Right. It added tens of billions of dollars to their market cap in a matter of hours, bringing them to that $406 billion valuation.
But wait, challenge me on this. Usually, Wall Street loves growth. If a company says, hey, we tried to buy a huge asset to grow and we failed, shouldn't the investors be disappointed? Shouldn't the stock drop?
Normally, yes. But in this case, the investors were terrified of something called the winner's curse.
The winner's curse. Break that down for us.
It's a concept from game theory and economics. In an auction where people have incomplete information, the winner is often the person who just overvalued the item the most.
Oh.
Essentially, if you win the auction, you probably paid too much.
So the investors were looking at that $80 billion price tag and just thinking, please, Netflix, don't do it.
They were thinking, if Netflix buys this, they're going to be distracted for a decade. Just think about it. If they won, they'd have to integrate thousands of employees. They'd have to figure out what to do with CNN, which is a totally different business model than streaming. They'd have to manage a massive new debt load. It's a huge headache.
It's the opportunity cost. If the CEO is spending all day in meetings trying to figure out how to restructure Warner Bros., he isn't spending time figuring out the next Squid Game.
Exactly. You nailed it. Opportunity cost is the invisible killer of companies. When Netflix walked away, the market let out a collective sigh of relief because it meant Netflix could go back to focusing on just being Netflix.
And the analysts back this up. We have a note here from Laurent Yoon at Bernstein. He called this a win-win-win.
Right. He maintained his Outperform rating, and he set a price target of $115.
Which implies there's still another 25% upside from here.
Exactly. And his key quote in the note was, "Netflix remains disciplined allocators of capital, a defining feature of their success."
Disciplined allocators. I mean, it's not the sexiest compliment in the world, but it's the one that makes you rich.
It is the highest compliment you can pay a management team. It means they aren't gambling with the shareholders' money.
Okay, so Netflix takes their ball and goes home, and everyone is happy. But someone did buy the thing. Paramount Skydance. They are the quote-unquote winners.
They're the victors, yes.
So what did they actually win? Did they win a prize or did they win an anchor?
Well, David Ellison, the CEO of Skydance, has effectively created a new media superpower. By combining Skydance with Warner Bros., he has built an absolute behemoth.
Let's look at the sheer scale of that for a second.
It's staggering.
Yeah.
You combine Warner Bros. Pictures with Paramount Pictures. You combine HBO with Paramount Plus. You combine CBS with CNN. It is arguably the largest collection of traditional media assets ever assembled.
And David Ellison isn't doing this on a shoestring budget either.
No, he has deep backing. His father is Larry Ellison, the co-founder and CTO of Oracle. So there's a technological and financial safety net there that most media companies just don't have. They could afford to take big swings.
But the sources we have here are flashing some serious warning lights for Skydance. It's not just a victory lap for them. There are massive risks.
Huge risks. The first one is regulatory.
Right. The federal government usually raises an eyebrow when one company owns that much of the news and entertainment landscape.
Exactly. This deal still needs federal approval. And regulators have been very aggressive lately regarding antitrust. So it's not a done deal until the ink is completely dry.
And then there's the human cost. The source notes mention, quote, substantial losses of employees and talent.
That is the really dark side of these mega mergers.
Yeah.
When executives talk about synergy, what they usually mean is firing the people who have duplicate jobs.
Right.
You don't need 2 HR departments. You don't need 2 distribution teams. So Skydance is facing years of messy, painful restructuring.
While Netflix is just kind of chilling.
While Netflix keeps its team completely intact and just focuses on the customer. They don't have to fire anyone. They don't have to merge 2 totally different corporate cultures. They retain all their agility.
But to be fair to Skydance, the market liked their move, too. It wasn't like their stock crashed.
No, you're right. Skydance stock was up over 20%.
Pushing the price up to 13.51.
Yes, the market believes that in the legacy media world, scale is the only way to survive. The thinking goes, if you're going to fight Netflix and Disney, you need to be massive. So Skydance bought size.
So Skydance bought size, and Netflix kept its freedom. 2 very different strategies.
Exactly.
Let's pivot back to Netflix's plan B for a second, because they clearly wanted to spend that money. They had $82 billion ready to deploy. Now that they aren't buying Warner Bros., what do they do with it? Do they just put it in a giant savings account?
Well, they could, but the better strategy is what we call organic growth.
Yeah.
And to understand why this works, you have to look at their current financials. We have the Q4 2025 earnings data right here.
Lay the numbers on us.
Revenue was $12.05 billion for the quarter.
Which is up 17.6% year over year.
Right. And net income was $2.41 billion, up 29% year over year.
Wait, pause right there. If they are growing their net income by nearly 30% without buying anyone, why were they even shopping in the first place? Why mess with a winning formula?
That is the billion-dollar question. And the answer is engagement.
Engagement. Explain that.
We are in an engagement war right now. The source notes highlight this specifically. Who do you think is Netflix's biggest competitor?
I mean, I assume it's Disney Plus or maybe this new Skydance monster.
You would think so.
Ah.
But look at the data on actual viewing time. The biggest threat to Netflix isn't HBO, it's YouTube.
Ah, the second screen. Or, honestly, for a lot of younger people, the first screen.
Exactly. Free, user-generated content is eating up more and more of the world's attention every day. Netflix knows this. Buying Warner Bros. Would have given them a huge library of old movies, which is great. But does an old episode of Friends on TBS really compete with a new Mr. Beast video?
That is a great point. Buying a legacy cable network is almost like buying a really nice horse and buggy factory right when Ford starts selling the Model T.
That's a bit harsh. But it's accurate. The future of attention is incredibly dynamic. So the analyst Laurent Yoon suggests that now that Netflix isn't spending $82 billion on old assets, they can redirect that capital.
Where does it go then?
Toward creating new content that drives engagement right now. Instead of buying the rights to Batman, maybe they spend that money inventing the next Batman. Or they invest heavily in live sports or gaming, things that actually compete with YouTube for your time.
So they have a massive war chest now. They have optionality.
Optionality is key here.
Yeah.
Skydance is now locked into a very specific path. They have to make this merger work. They have huge debt to pay down. Netflix can do whatever they want. In a rapidly changing market, flexibility is worth a massive premium.
I want to zoom out a bit here, because this deal didn't happen in a vacuum. We have some fascinating notes here about the broader economy in February 2026. The S&P 500 is at all-time highs. Everyone is euphoric.
It is a full-blown bull market. UBS is predicting the S&P could climb to 7,500 by the end of the year.
But then you have this counter-signal. We have a note here about Bill Gates sounding a massive alarm. What is the billionaire class worried about right now?
Gates is warning about dead ends.
Dead ends. That sounds a little ominous. What does he mean by that?
He means that in a market that is this high, where everything is incredibly expensive, people start making really bad decisions. They get desperate for returns. They start throwing money at things that look like safe assets but actually have absolutely no future growth.
Like maybe a bundle of declining cable networks?
You said it, not me.
Hmm.
But yes, that is the exact fear, that investors are overpaying for things just because they have cash burning a hole in their pocket.
So Gates is saying the market is frothy, prices are too high, and when prices are too high, what is the best investment strategy?
Often the best strategy is doing nothing. Patience. Keeping your powder dry.
This connects perfectly back to Netflix. If Bill Gates is right, and we are in a bubble of these dead-end investments, then Netflix refusing to pay $82 billion isn't just a business decision, it's a survival strategy.
It is a defensive masterclass. Think about it. If the economy turns, if the bubble bursts in late 2026, who is in a better position? The company that just leveraged itself to the hilt to buy a massive legacy media company. Or the company sitting on a pile of cash with no debt and high profit margins.
Yeah, it's obvious.
It reminds me of that famous Warren Buffett line, "You only find out who is swimming naked when the tide goes out."
And right now, Netflix is wearing a full wetsuit.
And Skydance, we'll see. They have great assets, don't get me wrong,
Yeah.
but they have a very heavy load to carry through a potential storm.
So let's bring this all together. We started this deep dive talking about that feeling of wanting the shiny object, the discipline to walk away. What is the big takeaway here for you, the listener? Because most of you aren't deciding between acquiring a movie studio or not acquiring a movie studio.
No, but you are making capital allocation decisions every single day.
Yeah.
We just call it spending. The lesson from Netflix is that action does not always equal progress. We live in a culture that screams at us to do things. Buy the house. Invest in the crypto. Start the side hustle. We feel like if we are standing still, we are falling behind.
FOMO, fear of missing out.
Netflix had the ultimate FOMO. Their biggest rival was buying their other biggest rival. The pressure to do something must have been immense, but they looked at the math, they looked at the reality, and they chose inaction.
And that inaction made them 14% richer in a single day.
It gave them the freedom to fight the battles they can actually win. It preserved their optionality.
So the discipline of the deal isn't about how good you are at negotiating. It's about knowing your walkaway price.
Exactly. You have to know your discipline threshold. At what price does this shiny object become a burden? If you don't know that number before you walk into the store or the boardroom, you're going to lose.
That is a powerful thought. In a world of move fast and break things, sometimes the smartest move is stand still and calculate. And we want to leave you with that provocative thought from Bill Gates about dead ends. If the market really is at an all-time high right now, is your smartest financial move actually doing nothing?
It's definitely something to consider. Where is your own discipline threshold?
Well, on that note, we're going to wrap it up. I'm going to go look at my own budget and maybe walk away from a few shiny objects currently sitting in my online shopping cart.
Probably a wise move.
Thanks for joining us for this deep dive. We will see you next time.